good afternoon and good evening to all. My name is Samira Khan, Manager, Technical Assistance at the African Tax Administration Forum. A very warm welcome to this virtual social learning session, where we will be discussing the use of third-party information to support risk management efforts in tax administrations over the next 2 hours. Before we get into the deliberations, I would like to invite Mrs. Mary Bainey, the Director of Tax Programs at the African Tax Administration Forum, to make some opening remarks. Mrs. Bainey, you are welcome.
Thank you so much, Samira. Good morning, good afternoon, everyone. Indeed, it is my pleasure to be part of this discussion where we will be looking at the use of third-party information to support risk management efforts in tax administrations. On behalf of the Executive Secretary of the African Tax Administration Forum, and indeed his Executive Committee, I wish to convey warm greetings to you all. It is my pleasure specifically to open this social learning event focusing on the use of third-party information to support risk management efforts in tax administrations that is jointly organized by the African Tax Administration Forum, the TADAT Secretariat, and the TADAT Partnership Group in Africa. I would like to express my sincere appreciation and thanks to everyone who has made this event a reality. The African Tax Administration Forum, in its quest to build capacity within revenue administrations, has partnered with the TADAT Secretariat to support tax administrations in developing skills and capacity to meet international good practice, leading to effectiveness and efficiency in revenue collection to meet countries' development needs. A recent highlight and outcome of this partnership was the provision of a joint TADAT training to 130 members, senior management members from different revenue administrations. At least 6 African countries were in attendance, which is indeed a very crucial step in equipping our leadership with the knowledge to implement international best practice within the administrations, and a clear endorsement and recognition of this tool as a key enabler. ATAF's aim, and through this partnership with the TADAT Secretariat, is to build institutional and human capacity within countries, intentionally developing continental expertise for sustainability through peer-to-peer support model, and therefore it is extremely impressive that most of the discussions today will be done by homegrown experts from the continent, with the net outcome being that the solutions realized by one jurisdiction can easily resonate with peers as their operational environment is very similar. Managing tax administrations, needless to say, and looking at the risk involved is quite complex, and having an effective risk management strategy is vital in ensuring that the tax administration operates optimally. This would mean deploying the usual limited resources meaningfully and effectively. Therefore, the use of third-party information cannot be overemphasized and is crucial in ensuring the accuracy of information declared by taxpayers in response to their tax obligations. The knowledge shared today by experts shall provide some tested solutions to some of the challenges in tax administration on the continent. These are robust steps to building modern, responsive, and effective tax administrations on the continent that will in turn enable effective resource mobilization for the development of the African people. I want to encourage you to seize this opportunity to optimally engage in the information sharing and engagement, and I really hope that everybody will enjoy every minute here today. I thank you and I wish you well. Back to you, Samira.
Thank you, Mary, for those very insightful remarks, and also highlighting the importance of risk management in Africa and in our tax administrations. So without further ado, I would like to continue with the program. In a perfect world, we would assume that taxpayers voluntarily comply, but this is often not the case, as you may know. Society needs tax administrators that work smart, prioritizing key risks using analytic skills that are consistently applied. Improved use of third-party information enhances the tax administration's ability to ensure that taxpayers declare accurate information whilst reducing the risk of tax fraud and tax evasion. This social learning event, focusing on the use of third-party information to support risk management processes, are more specifically how bank credit ratings can be used in tax administration, aims to enhance our knowledge to improve risk management processes. With that being said, I would like to invite our first speakers, Mr. Simon Muyunga, who is from the Uganda Revenue Authority and an ATAF Compliance Risk Management Short-Term Technical Assistance Expert, and Mr. Charles Lugemwa, Compliance Risk System Expert, also from the URA, who will provide an overview of compliance risk management. You are welcome to take the floor, Mr. Simon.
Thank you, Samira, and a good morning, good afternoon, and good evening to everyone. You are all very welcome to this session. In this particular session, we shall be talking about the using third-party information in management. If you will allow me to share my screen.
Recording in progress.
And allow me to start with in tax administration, as in many other disciplines as well, is many times more important than speed. What was given to us by Richard Evans, but it is practical it's applicable to us in tax administration, as it is within many other disciplines. And the work that we do with the compliance risk management is basically to do with determining this direction. A story is told of a man who sold a ship, a sailing ship, for say $6 million. Excuse me. Went ahead and declared this in their return, $6 million. The tax assessor on the other side looked at the transaction, and based on his of similar transactions, imagined that no, this one should be 9. And so, if you will allow me to use that right there. So you have a situation where the taxpayer insists that it's $6 million, while the tax assessor is saying it is $9 million. And this is a common dilemma for tax administrations around the world, because the taxpayer is going to declare one thing, and without, if you don't have any further knowledge about the transaction, what the taxpayer says will stand. Allow me to take a break on that and just highlight an aspect of the TADAT, particularly performance outcome area number 2, which talks about compliance risk, managing risk within the tax administration. And according to the TADAT, a good tax administration will undertake intelligence gathering and research to identify risks in respect of the main tax obligations. In a similar way, it will use a structured process to assess, to rank, and to quantify taxpayer compliance risks. A good administration will mitigate those risks that have been assessed through a compliance improvement plan, and it will set in place mechanisms to monitor and evaluate the impact of mitigation strategies on the compliance of the taxpayers. The POA2, of course, also expands into looking at risks as well. But it is against this background that we want to take off the discussion today. And particularly, we'll amplify the discussion about intelligence gathering and research to identify compliance in respect of the main tax obligations. Now, allow me to say that this on its own is a full discipline which involves, risk assessment, risk identification, risk assessment, risk ranking, and generating solutions, implementing those solutions, and monitoring and evaluating the impact of those solutions on the compliance of the taxpayers. We have a full complement discussion of this with the TADAT and with the ETAF, and I know the ETAF is always ready to support tax administrations in this area. And so if any of us would need assistance in any of these areas, I think it would be good to reach out. But because of time, we might not go through in each one of these steps. What we'll do, however, is to explore the one on intelligence gathering a little more. Now, if we go back to our tax assessor, you will remember that the tax assessor thought it was 9, while the taxpayer thought it was a 6. Now, in order for the tax assessor to be more confident, what the tax assessor needs right now is a level of assurance that what the taxpayer is declaring is correct. And in tax practice, this level of assurance is directly proportional to the amount of information that is available to the tax assessor. So in our story, the tax assessor then reached out to another person who was the buyer, the person who bought the ship from the taxpayer. The buyer informed the tax assessor that he bought at $9 million. The tax assessor also reached out to the banker. The banker also informed the tax assessor that the transaction was for $9 million. The assessor also reached out to the licensor of the ship, who also confirmed the transaction was $9 million. So it is this assurance that comes from all these parties that helps the assessor to arrive at a confident figure that the number was actually 9 and not $6 million. Ladies and gentlemen, this goes ahead to show us in a very simplified way the importance of having access to third-party information in the role of in our work as tax administrators. As long as we have information, that can back up what we are looking at in the taxpayers' declarations, then the level of confidence, the level of assurance of the tax assessor goes up and is able to determine, confidently the correct tax that is due to be paid. Assurance in a tax administration is therefore aimed at improving the quality of information for the individuals or the assessors that are making decisions. Getting independent assurance is a way to bring comfort that the information that the taxpayer provided in their declarations on which we are going to make tax decisions, that information is reliable, and therefore it helps us to reduce risk. And so agencies need to continuously identify entities that generate reliable data, be integrated with the data that we have internally, to be able to derive insights into taxpayers exhibiting non-compliance behavior. And there are many sources of this third-party info. We have banks, credit rating institutions, registrars general, motor vehicle, the trading license, gambling regulators, import information from customs, foreign currency transactions, of late, social media as well. All of this information can be harvested, put together, and processed to come up with a more comprehensive of the taxpayer's profile and indeed the taxpayer's behavior. Samira, at this point, I would like to invite my colleague, Charles, to come and take us through the rest of, well, to quickly take us through the rest of this presentation. Charles?
Thank you, Simon. And thank you, Samira, and thank you, everybody who is on this forum. The challenge that is usually before us is to verify the information that is presented to us by the taxpayer. And what Mr. Myonga has just talked about, he has just described the ecosystem that we need to understand in order to verify the information presented to us. If you look at ourselves as revenue agencies, the challenge usually is that taxpayers are not willing to give us comprehensive information about their transactions. So we need to identify a person who they are confident at exposing that information so that we can work closely with him in order to ascertain that the information they have presented to us is valid and reliable. We also know that many of the credit reference bureaus are relying on the information that they are getting from the taxpayer. So they are only having one side of the story from the taxpayer, and that side of the story is always good, because a taxpayer will never give bad information about his business when he's trying to borrow. So in other words, you find that revenue agencies have partial information about the taxpayers, and you also find that credit reference bureaus, because they are not taking any information from revenue agencies, they are also having a partial view of the taxpayer. So how can we work closely together in order to come up with a risk management framework that will cushion the risk that is exposed to each of the entities? That is the banks and the credit reference bureaus, and then the revenue agencies. Credit reference bureaus, Simon, you can help me move the screen, please. So credit reference bureaus are usually charged with rating the taxpayers. So they usually rely on the information availed through the books of accounts, through the sources of revenue that is declared by the borrower, and they base on that to compute the credit rating of that borrower. Now, the idea is, what if we built a process or a system where revenue agencies exchange compliance information with the credit reference bureaus, and also credit reference bureaus exchange information with the revenue agencies? The dilemma that we have usually is that when someone goes out to borrow, his collateral at a certain point can be attached by the revenue agency. That is when he has some abrupt assessment that comes up due to the non-compliance to certain tax. And when an asset that was used as a collateral is attached by a revenue agency, that exposes the banks that lent money to that business. So it's very important that banks work closely with the revenue agency so that they are able to ascertain the risk that is associated to the person they are going to lend before they approve the loans to those people. Because when the revenue agencies attach those assets, or when these entities are closing down, revenue agencies are given the first priority of recovering their money before other lenders are allowed to tap into the resources available. So it's very important that revenue agencies work closely with the financial institutions in order to come up with a reliable risk level associated with each of the borrowers. Simon, you can move to the next. So tax administrators need to share compliance information with the credit reference bureaus. And when we share our compliance information with the credit reference bureaus, the credit reference bureaus will use that information in the computation of the credit rating of those taxpayers, meaning that taxpayers who are not compliant with us will have a poor credit rating at the credit reference bureau, and therefore they will be looked at as risky borrowers from the perspective of lending. And that means that if they are to borrow, they will borrow at a higher interest rate. They will also be denied certain opportunities. So the cost of compliance for that non-compliant, the cost of non-compliance for a taxpayer who is not compliant with that will be higher because of the fear, because all businesses survive on loans. That will force them to voluntarily comply with the revenue agencies. And that way, revenue agencies will never have an opportunity of attaching a property that is a collateral, that is put forward as a collateral by one lender, by one borrower. Now, we believe that if taxpayers value the relationship, if taxpayers value the credit ratings, then they work very hard to ensure that they comply with the revenue agency, because the repercussions of non-compliance are very high and they will not afford the cost. On the other side, revenue agencies will realize voluntary compliance from borrowers, and that will reduce the cost of managing compliance, and it will also help them reduce the time spent while trying to locate most of these taxpayers. Because when we looked at the data for the Credit Reference Bureau in Uganda, they have more borrowers on their register than the taxpayers we have on our register. So it means that working directly with them will give us visibility into those individuals, especially that are not compliant with us, but they are eager to go and borrow from the commercial institutions. So Credit Reference Bureau should share with tax administration about the information regarding the credit rating, the income sources. Sometimes taxpayers declare a few of their income sources to the revenue agencies. They also have assets that are not revealed to revenue agencies, but they are revealed to the Credit Reference Bureau. And in return, tax administration entities will share information about the declared income. They will also declare the non-compliance scores to the credit reference bureaus. If a taxpayer does not own any rentals according to the revenue administration information, then it will be very difficult for the credit reference bureau to take it as valid information if it doesn't exist in the revenue agency. And when taxpayers get to know that information is shared, then they will have to comply with both parties, and that will reduce the cost on both sides. Simon, can proceed. So, non-compliance will mean poor credit rating for those who are not complying. And if you have a poor credit rating, then your cost of the loan is usually higher. And because businesses are always interested in lowering their cost of borrowing, they will have no option but to comply with the revenue agency. So as a result of that, the cost of compliance will go down. Banks and other lenders will have a reduced risk of lending to borrowers, because collaterals sometimes are seized by tax administrations when the borrowers have not been compliant, and an audit results into a very huge liability that lenders never anticipated when they were evaluating loans. So we believe that working closely with the financial institutions, with financial institutions and the credit rating institutions would greatly bring benefits to both the financial institutions and revenue agencies. If you do not know, if you do not invest in risk management, it does not matter what business you are in, it is all risky. I thank you so much, and I hand over to Madam Samira.
Thank you very much, Charles and Simon, for that excellent presentation. And I really liked the saying, direction is uh, more important than speed, which just amplifies the importance for third-party information to efficiently manage risks and be able to verify information being declared by the taxpayer. And as Charles has also highlighted, the importance of working together with the Credit Ratings Bureau, which can be a mechanism to increase not only voluntary compliance, but also improve the accuracy of declarations being received by our tax administrations. With that being said, and that introduction to how tax administrations can work together with credit rating bureaus, I now have the pleasure of inviting Mr. Richard Tumusime. I hope I have pronounced your name correctly, and apologies if I haven't, from the Metropol Credit Reference Bureau and a credit rating expert to talk to us through bank credit ratings and their relationship with managing risks. Thank you very much. And over to you, Mr. Richard Tumusime.
Thank you, Samira, and all the participants in this discussion. Allow me to share my screen. I thank Charles for giving me a good background to my presentation. Thank you, Charles. We thank the organizers for inviting Metropol to this discussion. We are very grateful. Richard Tumusime is my name, and I'm the General Manager, Metropol Credit Reference Bureau, based here in Kampala, Uganda. Allow me to...
Sorry, Richard, can I ask you to put your presentation in presentation mode, in full screen slideshow? Thank you.
Yeah, yes, now.
Great. Thank you.
Yeah, allow me to talk briefly about Metropol. Metropol CRB is a licensed entity by Bank of Uganda, and we are licensed in 2015. So we have been running the race for the last 7 years now, but we are a subsidiary of Metropol Corporation Limited, which is based in Nairobi, Kenya. Unfortunately, Metropol Corporation Limited also runs a credit rating agency. So that company has been in operation since 1996, and it is now 26 years old. So what we do as a bureau is collect and collect credit data from Bank of Uganda regulated institutions, and then provide or generate the resultant credit reports, which we again sell to these institutions at a fee. So important to note is that these institutions submit to us only credit data, not bank account details of their customers. We only have credit details. So if you have a bank account, you may also have a credit account with the same bank. So the bank submits to the bureau your credit account details, not bank account details. So we also developed other value-added solutions that we offer to these financial institutions at a fee. So that's how we manage to get some money, keep us running. Allow me to present briefly the current credit information sharing situation in Uganda. So there are 35 financial institutions which submit data to the bureaus. And this one is done on a monthly basis. We have 3 bureaus operating in the market. And as at December last year, the number of credit records at the bureau was 2 million. And that was for individual borrowers. And then for non-individual borrowers, we had 49,052. So non-individual borrowers refer to companies. Yes, companies. And for any financial institution to be able to submit data to the bureau about any borrower, that borrower must be uniquely identified. And the unique identifier that is used in Uganda is the financial card number. So every borrower that has a credit facility with a Bank of Uganda related financial institution has a unique identifier called financial card number. However, we are engaging the central bank to allow the use of the national ID as the unique identifier going forward, because the uptake of national IDs is more than the financial card number. The credit data we have at the bureau is updated continuously as and when errors are detected by either the bureaus themselves or when customers raise disputes. In the regulations that govern the operation of credit reference bureaus, there is a provision that a borrower is entitled to a free credit report once a year. So what that is intended to help is that if you access your report, you can be able to analyze it and detect any errors that could be there, and then that will form the basis of you as a borrower to raise the dispute, either with your financial institution or the bureau itself. But I want to make a clear distinction between credit reference bureaus and credit rating agencies. So CRBs generate credit reports or credit scores on individuals or non-individuals based only on information supplied to them by the credit providers. So that's the basis of us generating credit reports or credit scores for each and every borrower. So credit scores are numeric in nature. For example, I can have a score of 200, 500, or 900. So to us, Metropol as a bureau, our score ranges from 200 to 900. And 200 simply means you have a poor credit quality as a borrower, whereas 900 is excellent credit quality. So you see, the scores are numeric in nature. Whereas credit rating agencies are companies licensed to assess the creditworthiness of business entities, local governments or districts, or even countries, based on both objective and subjective information. So a rating agency uses both objective and subjective information, whereas a credit reference bureau uses only objective information based on the data provided to it by the credit providers. So we have different types of ratings offered by our parent company, Metropol Corporation Limited. We have sovereign or county or district ratings. Then we have corporate ratings and SME ratings. But these ratings are alphabetic in nature. So they are different from scores. A rating is alphabetic, e.g. A plus, B plus, etc. So the interpretations differ depending on the rating you get. If you are A plus, it means your creditworthiness is high, and therefore lenders can easily give you credit. So a CIB, for example, cannot generate a credit report on a country like Uganda, but a rating agency can develop one. So that is the main difference between a credit reference bureau and a credit rating agency. Also, CRIBs are regulated by central banks in their respective countries, whereas credit rating agencies are regulated by capital market authorities in those respective countries. So the regulators are also different, but their work complements each other. So at the bureau, there are different categories of information that you can find on someone's credit report. For example, we shall have your biodata or KYC for both individuals and non-individuals. And then employment history for individual borrowers, previous credit applications. Which applications have you made in the last 2 or 3 years or 5? Or how many inquiries have been made about you by the different lenders? And then we shall also show you loan accounts held with various lenders and how they are performing. So we give the details of each and every loan account you have with every lender. And also we show you material collateral, like Charles was talking about. So material collateral you have pledged to get credit facilities will be shown on your credit report. And then guarantors, which individuals or non-individuals have guaranteed you to get a credit facility. Stakeholder information, if you are an individual and you are a director or shareholder in another company, we shall show that link on your report, and we show which companies you are a director or shareholder. If you are a company, then we shall show on your report the link to the directors, the company directors. So someone, a lender, will be able to relate that information and make an informed credit decision. We also show you fraudulent activities. If you have ever been involved in any fraud and it is reported to the bureau, we shall show it on your credit report. Bounce checks issued by both individuals and companies will be shown on your credit report. When time allows, I will show you an outline of our credit report later in the presentation. So how can tax administrators utilize credit reports, for example? I would believe that a tax person would be interested, especially in bounce checks, because this one reflects the financial character of the taxpayer. If you are issuing bounce checks, you are lenders, what is the probability that you will be paying your tax obligations? Outstanding loans, how much and for how long? That's very important. Days in arrears, timeliness of loan payment. If you are taking time to pay your loan obligations, it means you are most likely also to delay payment of your tax obligations, because experience has shown that taxpayers tend to prioritize loan repayments as opposed to tax payment. They fear loans than paying taxes. So if somebody is reporting on a loan, then to you as a taxpayer, as a tax administrator, it means you are in serious trouble. Prayers alone may not help you. So once you look at somebody's report, you can be able to assess and see the different collection strategies you can apply on this taxpayer based on how he's paying his loan obligations. And then biodata and contact information, you need to appreciate to see whether the biodata displayed on someone's credit report is actually consistent with what you have. Because we believe this is important in skip tracing, especially for individual taxpayers. People change information here and there, and by the time you are trying to follow them up, their contacts are off, their phones are off, the emails are bouncing, and you don't have any alternative source of biodata you can use as a taxpayer to trace that person. Stakeholder information is also important. If you're dealing with an individual stakeholder, you need to understand which other companies the person is associated with. What is their tax payment history as held by you, the tax administrator? And then fraudulent activity. That one can also give an indication on whether the taxpayer declares or pays the right tax amounts. Falsification of records is common among taxpayers because most of them would prefer a lower tax assessment. So if somebody can be fraudulent in terms of his credit dealings, then there is a high likelihood that he may also be fraudulent when declaring revenues for purposes of tax assessment. So once you see that there is any fraudulent activity reported on someone's credit report, then you need to take maximum care. We believe that therefore, once a credit report is incorporated as one of the risk assessment tools in tax administration, it can help to minimize tax defaults, some of the benefits Charles hinted on them, reduce cost of tax administration, improve skip tracing, reduce penalties imposed on taxpayers, and consequently an enhanced tax collector relationship. So it's important that tax administrators partner with credit reference bureaus to ensure that they get access to the information available at the bureau for purposes of managing compliance risk. So how can tax bodies like Uganda Revenue Authority here in Uganda partner with Metropol or with other CRBs? The current legal environment is such that other credit providers outside those regulated by the central bank are not yet allowed to submit credit data to the bureaus. However, the law is in place to allow such credit providers and other interested parties like URA submit information to the bureau. But the enabling regulations are what have delayed. And as bureaus, we are pushing Bank of Uganda to ensure that it releases the enabling regulations so that now institutions and tax bodies like URA can start reporting tax compliance data to the bureaus, that they become part of the credit report. So, however, given that currently the law does not allow institutions like URA to access CRB reports directly, you need the customer's consent first. So the taxpayer has to give you consent as a tax body that, okay, you can access my report from the bureau, and once we receive that consent as the bureau, we generate the customer's report and share it with you directly. And that can only be enabled through an MOU, which you can enter into with the tax body, and then a customer requests for their report, we send it to you directly at a small fee, of course, at a small fee. However, tax credit reports can also use it for different purposes to help the efficiency of the tax bodies. For example, understanding the financial character of your suppliers or service providers, as well as in the recruitment of key staff, especially at supervisor level and above. We have had reports of corruption among tax assessors, and some of that corruption can be traced back to the financial character of those individuals. If someone has a big loan burden in the financial institutions, he will use all means to get money to ensure that he clears his loan obligations. So when you look at somebody's tax credit burden as a recruiter, as an employer, you can tell whether this guy will actually be honest in his dealings, given the high debt burden he's carrying. So it's such characters that create a bad image for the tax collectors, or for the tax bodies. So it's important that as tax bodies, you also incorporate credit reports in your recruitment processes. Allow me to display briefly the structure of a credit report. This is how our report as Metropol is structured, and as I have been saying, we have a section for verified identity, meaning biodata or KYC. So for individual borrowers, we shall have a photo here for the borrower. However, for non-individuals, the photo won't be displayed because, as you are all aware, photos apply to human beings and not corporate beings. The same case with marital status and gender. So some of those elements will not be available in a non-individual report. But for an individual report, we shall give you all those details. And therefore, you'll be able to know all the biodata associated with the taxpayer and compare with what you will have at the tax body. Employment information section is also captured here. You know how much somebody is earning and whether what he's paying in pay as you earn or income tax is commensurate with their earnings as reported at the Bureau. And then this is the stakeholder link I was talking to you earlier. If you have links with companies, we shall show the financial card number for the company, the business name for the company, the trading name, the business type, and the industry or sector. So you can trace the individual taxpayer to the other companies he's associated with. So this is the score, the Bureau score I was talking about. Our score ranges from 200 to 900. So this particular customer has a score of 780, meaning he falls within the band of excellent credit quality. So once you assess, you look at the customer's credit report and you establish that their scores are good, the probability that they would also be good taxpayers is also high, because it means such customers care about their legacy, their name. They don't want any dishonesty in their dealings, and they pay their obligations on time. So somebody's credit score will give you an indication as a tax assessor on how he is likely to behave when it comes to tax payment. And our report will also show you the movement, how somebody's credit score has been moving over the last 12 months. Has the credit quality been declining or improving? So that one will also give you an indication. And also the payment performance index shows on average how many days somebody takes to pay their credit obligation. So if somebody takes over a month, 2 months, the probability that he's also likely to delay to pay their tax obligations is also high. So once you look at the way the person is paying their credit obligations, it will give you an indication on whether this guy will actually clear their tax obligations on time. And therefore, if that is the case, you devise different collection strategies that will put pressure on your tax client to pay on time. So the report shows a summary of all the credit accounts that the customer has with the banks, so that before you go into the individual details of each credit account, you have an idea. So for example, how much is the outstanding loan obligation for this taxpayer? And what is the monthly installment? What is the highest principal he has ever taken? What is the highest balance? So all that information will give you an idea of your tax payer. Importantly, is these are the details of each and every credit account. I'm not going into them in the interest of time, but importantly is the bounce check section here. So we show the date the person issued the bounce check, which institution reported that incident, how much was the check amount, and what was the reason for the bouncing. So that information is captured on somebody's credit report. And I believe it can be important to you as tax administrators. And also financial malpractice. If there is any incident that this borrower has ever involved himself in, and it was reported by the financial institution, we shall capture it on their report. So we capture the incident date, the reporting institution, and the loss amount. How much was involved in that fraud incident? So guarantors are also shown, which people or organizations are guaranteeing this person secure their credit facilities. And then this is the material collateral, the collateral information that I have talked about earlier, will all be displayed here. And therefore, as a revenue agency, you'll be able to see which properties the person has pledged in the financial institution as collateral. If there are any that you would want to attach, are they already pledged as collateral? You'll see that information here. It will be on the customer's credit report. So this is us as Metropol, and I believe that partnering with credit reference bureaus is the right thing to do. And once the tax collecting or the tax administration agencies like URA start submitting data to the bureaus, it will even go further to enhance the value of the credit reports and the importance that taxpayers and banks and also tax bodies attach to the tax payment processes. Thank you very much. Over to you, Tammy.
Thank you very much, Mr. Richard Tusime. And thank you for that very insightful presentation. I myself have learned quite a lot of new things. It can be seen clearly from your presentation that the information that is housed by the Credit Reference Bureau is very valuable and will contribute to managing the risks of not only taxpayers but also service providers to the tax administration and employees, because you are able to look at a lot of information and cross-reference, for example, against outstanding loans which could give you an idea of how much person is earning, and comparing that to the declaration that's being made. For example, if a taxpayer has 2 or 3 house loans, how is he actually paying that, and whether that is in line with what is he earning. So this is some of the things that can be used to cross-reference and identify risks within the tax administration. But also, it also shows you, how you can use the Credit Rating Bureau to improve compliance. But I also want to thank you for highlighting and giving us some insight into how we can build our relationship with credit rating bureaus, and what is the process, to get that exchange of information from a credit rating bureau. So thank you very much for sharing that presentation of yours. Before we go into the panel discussion, we have a poll that we want to run. The poll will be shared in this format. It only has 4 questions, and it should take you not longer than 2 minutes to complete. We will first share it in English, then in French, then in Spanish, and then in Arabic. So over to you, Annette and team, to share the poll. Thank you. So please complete the poll, because this the information that you share with us here will also help us, to learn new things, and to also identify areas that we need to focus on in assisting our tax administrations. You have 2 minutes for the English one, and then it will be closed, and then they will put up the next one. Are we sharing the results after each language, or are we sharing the results at the end?
Let's share them as I.
Sorry, we can't hear you clearly.
We'll share after each language.
Thank you. So currently you can see the outcome of the poll in terms of the English-speaking participants. And it seems like 78% of the participants are aware of how you would rate the risk, or how the risk-aware culture is in a tax administration. And from the poll, it seems like most people are aware of the importance of managing risks overall within a tax administration. So I think we can share the next one. So in French.
Glenda, you have the French one ready? And the results?
So the results for the French-speaking participants reflects that everyone is aware of these processes within revenue administration and the importance of them as well. So this is fantastic. Thank you. Let's move on to the next one in Spanish.
Spanish and Arabic results. You can show them simultaneously. Samira, over to you.
Thank you very much, Justin, and thank you for completing that poll. As you can see, the previous presentations have set the scene for the rich and exciting panel discussion, which will deliberate on how the credit ratings can be useful for tax administrations. It is my pleasure to introduce our moderator for the session, the Executive Director of the Commonwealth Administration of Tax Administrators, CATA, Mr. Duncan Onduru, and our panelists, Mr. King Jeffrey Ngobonzima, the Head of Risk Management at the Rwanda Revenue Authority, as well as Mr. Gilbert Kwezi Mensah, who is the Assistant Commissioner Risk Management at the Ghana Revenue Authority, and lastly, Mr. Ezekiel Piri, Director Research and Corporate Strategy at the Zambia Revenue Authority. Unfortunately, Mr. Wilson Muraya, the Chief Manager of Enterprise Risk Management at the Kenya Revenue Authority, was not able to participate today, but we have three excellent panelists, and I now invite you, Mr. Onduru, to chair the panel session for the next 50 minutes. Thank you.
Thank you so much, Samira. Good morning, good afternoon, good evening, dear participants. It is my pleasure to chair or moderate this upcoming session. But before I do that, let me also add my voice in thanking the TADAP Secretariat and the African Tax Administration Forum for the partnership we've had over the years, which continue to grow from strength to strength. I know the TADAP Secretariat has been doing a lot of heavy lifting in terms of coming with this tool and modernizing it as we go along to take care of the emerging challenges. So I must appreciate them for doing such a commendable job. I also wish to thank the previous speakers who have taken us through very thought-provoking presentation, the presentation from the Uganda Revenue Authority and the presentation from the Metropol. Unfortunately, we would have been very happy to hear from the other gender, and I see all my panelists are men, but I know they are men of substance, so I will not cry foul. I hope within our audience we have ladies who will be actively participating in this discussion. Let me, as an opening remark, just say that with the overhaul of international tax rules, which has ushered in more transparency and disclosure requirement, tax administration are now in a more better position to target their compliance strategies. The tax compliance life cycle is significantly being transformed. The way tax administration are collecting information, the way they are doing their risk management and selecting and auditing taxpayers is massively shifting from human intervention and interpretation, and is now being supplemented by data analytics, machine learning, and artificial intelligence. And we all know that data analytics is being used to examine taxpayers from every angle now. I must also say that TADAT remains a very handy tool to assist in this process. We all know, and from the experience that we've had, the talks around, is that this particular performance action outcome area has been such a big challenge, that is the risk management. And I think that informs the debate that we have today. So my panelists have been introduced, so I will not go back introduce them, but I wanted them also to share with us some of their thoughts on a few questions which have been lined up. But in ushering them in, I always like one famous quote. I think it's a quote of a long time, and it says, "A tax collector should collect taxes from taxpayer like a bee collect honey from a flower in such an expert manner without disturbing its petals." And this brings in the issue of balancing between how you do your risk and how those risks impact on the other side of the divide. So my first question that I would want to put to my panelists, and I will go in that order: how can we balance the compliance risk appetite and the compliance risk tolerance within the tax administration? And I would call upon first Mr. Ezekiel Fili to share his thought on this before I give the floor to the other panelists. Ezekiel, welcome to the floor. Ezekiel, are you there? Ezekiel?
Samira, this is Laban from Zambia. It appears Ezekiel is not yet on the call. I'll revert back as soon as possible to get
Thank
more
you,
there.
Laban. Go ahead, Laban.
It seems like Ezekiel is not on the call at the moment, so maybe you can move on to the next panelist, and while Laban will just check on him. Thanks.
Geoffrey, could you take the floor and give us an insight on the question I've just posed?
Thank you, Onuru, and thank you to all who are able to be on this platform. Allow me, before maybe I dive into answering the question you've put on board, to recognize those who spoke before me, especially Mr. Richard, Simon, and Charles. They really made a very good introduction to this discussion, and I would really like to extend my sincere thanks to the insights they put into the discussion. So, in light of the question you asked of how tax administrations could balance the compliance risk appetite and compliance risk tolerance, I believe it is the goal of all tax administrations to consistently grow the tax base. In doing so, you realize that the risk appetite in general, the risk capacity our institutions are willing to take also grows. But what I want to put forward is that tax administrations should not be blinded by that bulk growth in terms of tax base, which consistently goes with the risk appetite that they are willing to take, and forget to take articulate steps that will inform the kind of risks that shall remain behind after all controls are put in place. I as someone in charge of risk management believe that in my institution, of course, believe that there is no such a moment that you can sleep comfortably and believe that you've put in place all controls that should mitigate all your risks, because businesses and environment around us is always growing. As it grows, definitely as tax administration, I had alluded to that, it would be much wise to grow at the same pace or even at a higher pace, so that we can tap into these taxable areas that could probably go unnoticed. But again, it's wise to sit back and reflect and see whether we are not falling in a trap of whereby we will find ourselves, chewing what we will not be able to swallow. I believe that is where now the balance should come in. Risk management is dynamic in nature, and it should always be as such. So I believe one of key areas that I think is very critical in striking this balance is always having up-to-date data that we can root from any sources that we believe we have a direct or an indirect linkage, in that we are informed ahead for strategic purposes, for forecasting purposes, for even assessment purposes, even if it means reflecting backwards, because he who doesn't know where he comes from cannot tell where he's going. So in this regard, I am of the idea and the view that it is always good, like I may not quote rightly the quote you put, that we try as much as we can as revenue administrators to be in such good terms with our stakeholders in all circles, in that there comes a point whereby a tax administrator is not looked at a traffic police on the road. Some of us tend, to, even if you're clean, we tend not to like to see them. So it would be always good to engage, be in collaboration, exchange information where possible, where not possible, strive to achieve that, in that we have all the info that we need that will enable us to know whether what we are trying to venture into is viable and sustainable, because it's not what it always looks like. You may see a situation and you think it's an opportunity for you as a revenue administration, and then first year it works, second year it works, but it may backfire and destroy all you've been trying to build. So to narrow this to just outlines, it's paramount for revenue authorities to always have information and try to have as accurate information as possible, build partnerships with those we believe could provide us with relevant information that will help us to predict and measure what our capacity of risk is and what we would be willing to remain with after all mitigations are put in place. I would like to rest it there, unless if maybe there are questions for clarification. Thank you.
Thank you so much, Geoffrey. Could I will also hear from Gilbert Kwesi Mensah, if you could also share your thoughts on this?
Yes, yeah, sure. Thanks, Onduru. And I also would like to first of all thank or express my appreciation to the organizers of this forum. It's indeed a pleasure to be part of this team and to also hear from, other panelists and colleagues working in that administrations. So, on the subject, personally, I would say, yes, striking a balance is very important. But a key aspect of this, like my king just said, risk is dynamic. And when it comes to tax administration, it's a lot more, let me say, it's a complex field. Over the years, taxpayers have become more sophisticated, they become more enlightened. The mode of operandi, come talk of, the field itself, automation have set in and a lot of things has happened, unlike before. So for the risk professionals as well, or practicing risk in this institution, we also have to appreciate these changes or these dynamics. A challenge, however, which probably I'll acknowledge in my part, and I'm quite sure probably could be the case for most tax administrations in our part of the world, is that I often say when I go to meetings that risk management in GRA, for instance, is playing the catch-up, in the sense that the core businesses of tax administration is to mobilize revenue, and most often than not, that is the main focus in most deliberations. Risk management is sometimes become an afterthought. So yes, they're chasing revenue, they're taking out initiatives, but we don't often get carried along. So our involvement, to say the least, is critical. So for example, if you take audit, for instance, with the lack of resources or limited resources, without proper risk management, you may end up chasing a lot of your taxpayers who may not necessarily bring in or contributing much. But if you're able to risk profile them, I mean, involve risk in auditing your taxpayers, you realize that you're probably going to spend less energy on the limited resource you have going after key people who really should be your focus, and of course, retain as much revenue there as you can. So for me, it's difficult to strike that balance. I mean, rather let me say, you know, talking about the risk appetite, moving towards the tolerance limit. But I would say to get to that point, to have a good balance, it's about time tax administrations pay a lot more attention to the risk management function within those institutions, you know, and see us to be a critical part of the business. In that way, I mean, I would rather say that way we'll probably get to a place whereby we'll be able to have a good balance between the risk tolerance and the risk appetite. Having said that as well, one last thing I'll say is that I mean, automation and being able to have a more scientific way, or having what I would say, moving away from the manual process of risk management to electronic way or automated ways of managing risk, also to a large extent help in getting a good balance. So that I'll just leave it here for now.
Thanks so much, Gilbert, for sharing your views on the same. And
Mr. sorry to interrupt you. Sorry to interrupt you. I just wanted to update you that we have Mr. Laban Simbie, who is from the Zambia Revenue Authority, who will be representing Mr. Piri here in this panel discussion, because unfortunately Mr. Piri can't make it. And he is the Assistant Director at the Zambia Revenue Authority in Analytics Services. So I just wanted to let you know before you continue so that you can involve him in your panel discussions. Thank you.
Thank you, Samira. And Laban is a familiar face to me. We have bumped into one another a number of times. So we are looking at striking the balance between our risk appetite as tax administration and our compliance risk tolerance. And we often hear that tax administration have such a high risk appetite that they would kick everything out of the way because of revenue consideration. And I'm reminded of one joke that used to be shared sometimes back, that we had an amateur medical practitioner, and one time he made a remark that, the operation was successful, but the patient died, which was a very unfortunate comment. So that's the light in which some of the tax administration are being seen through their overzealous push. Sometimes the patient dies and we say the operation has been successful. But beside that, let me give the floor to Laban. Laban, just a quick comment on this, the balance between our risk tolerance and our risk appetite as tax administration.
Happy to see you, Mr. Ondoro. It's been a long time. And good morning, good afternoon, colleagues, wherever you are. My name is Laban Simbe. I'm sitting in for Ezekiel Piri, who was supposed to be with us on this panel, but I have to speak for him today. Just as well, I'm the Assistant Director in charge of Analytics Services Center within the Zambia Revenue Authority. Now, there's a tendency by revenue authorities, Mr. Ondoro and Madam Samira, to focus heavily on meeting the targets. And you see this right across the entire continent you've asked. And it's quite a serious problem, because to ensure compliance, you need to have systems and processes that should work perfectly, almost perfectly, all the time, or most of the time. Giving our example, the very first data assessment that was conducted on Zambia revealed that we were quite weak in using especially risk management and compliance approaches, standard risk management and compliance approaches. And this finding was repeated in a follow-up assessment that was done about 3 years later. And it was at that point that we woke up to the reality of this problem and began to do something about it. I will explain a bit further as we go on with the discussion in terms of what we've actually done, to make sure that we are responding to the risks that we face in collecting taxes. Thank you so much, Mr. Angu.
Many thanks, Laban. And if there is any intervention from the floor, just raise your hand and we'll give you a second or so to put your intervention. But let me move a step further. We've just had a very elaborate presentation from Richard on the CRB, and he's enumerated a number of sources of information that they rely on in generating their report. And the one thing that I didn't hear him saying is whether there's any report that they get from the tax administration. Maybe he'll address that. But for my panelists, how do we reduce the cost of compliance management through strategic partnership with the credit reference bureaus that we have in our respective country? And I would give the first chance to Geoffrey, if you could put your thoughts into that.
Thank you, Onuru, once again. There is no one single way in my understanding that would decisively reduce the cost of compliance management through partnership with Credit Reference Bureau, to be specific, but I would prefer to even make it more general, only that today we are on credit reference. It is my belief that partnerships are more vital than ever today. And this is due to the fact that economy is changing at an unprecedented rate. So that means, like I had alluded to in my first intervention, that revenue administrators need to position themselves in a way that we move at the same pace or even ahead of that. So I'll just make 3 points that I believe would really be of importance in this case. One is to streamline tax administration services. What do I mean? I mean enhancing our performance in terms of digitizing and automating most of the operations, so that our stakeholders, be it taxpayers, be other people that we work with on a daily basis, could access at least minimum required information without always having to write letters or make endless requests, so that at least the time we would spend on responding that, we would spend maybe doing audits, whichever type of audits we are making. Secondly, is establishing trust by offering quick and quality services to our taxpayers, and in this case, those who come towards tax administration for seeking any services, because it is my belief that, like in any other services, our stakeholders may be suffering, long queues or even prolonged waitings, awaiting for services that, end at costing them opportunities to go about their businesses, but in return that also costs revenue administrations. And lastly, but not least, is continuous innovation, because as risk management is dynamic, so is the environment around us. So we cannot always be in a comfort zone without making innovations that will ensure that we are working harmoniously with our partners, our stakeholders, so that as these technological advancements come in, as changes in laws come, we make innovations that will fit in that environment so that we are always on top of our game and we are not left behind, because failure to do that would be much costly and we would end up not meeting our mandate. I would like to rest it there for the time being. Thank you.
Thank you, Geoffrey. Could I call upon Gilbert to give his intervention on this?
Yeah, sure. Thanks again for the opportunity. Yes, how do we reduce cost of compliance risk management through strategic partnerships like Credit Reference Bureau? So, first of all, yes, in the how things are operated lately or how things run lately, definitely there's a need for partnerships in every sphere of life. So, specifically for tax administrations, I mean, yes, in the instance whereby almost year on year, I mean, the target for, I mean, let me use my Ghana Revenue Administration, for instance, Revenue Authority, sorry, where this year our target is to raise almost 40% above the previous year. There's a need to leverage on whatever partnership we can establish to achieve that target. And one of them will be to, if there's opportunity to have this with the credit reference bureaus, perfect. So if that's the way to go, for me, I would say that I don't know how many tax administrations right now are doing that in terms of having this partnership. I mean, if I use Ghana as an example, to the best of my knowledge, we are not. It has come up at a discussion before, but I can say with some degree of certainty that we've not had that partnership with them within a credit reference bureau in Ghana yet. Reason being that probably we need to have credit bureaus with certain level of reputation. And how can we get them to have that reputation or qualification, if you like, or standard? Is to ensure that most of the information that these bureaus need to have a good assessment are from banks. And I've had some experience in the bank before. And it's also the case that banks are often hesitant. In our part, I mean, let me keep it to Ghana. Banks are quite hesitant in providing or divulging certain information to these reference bureaus. Sometimes they even are of the opinion that, well, if I'm, example, reporting that high non-performing loans to some of these institutions, it's an indictment on the bank. It doesn't look good on me. And some as well have got customers that they consider to be high or key clients for them. So if those customers are not, let's say, fulfilling certain obligations or meeting their loan repayments, they are again unwilling to disclose this to the Credit Reference Bureau. So I would say that for a start, these bureaus, there should be a strong legislation backing them. I mean, to ensure that, example, financial institutions are duty bound or obliged to provide them with those information. So where that confidence is built in the credit reference bureaus, it would naturally be considered to have such a reputation, so that, I mean, tax administrations and other institutions would readily fall on them, you know, to meet some of this, to close this compliance gap and other things. The best place to be for a tax administration, obviously, is to have a very high level of voluntary compliance. And then again, to achieve that, I mean, taxpayer education is also very key. You know, if the taxpayers are well aware, which fits back into the presentation made by our colleague from the Credit Reference Bureau, I mean, it's important that we get the taxpayers to know their commitments or their responsibility when it comes to, I mean, if I know, well, if my information with the bank, I mean, most taxpayers, or all of them have accounts with the bank. If I know my relationship with the bank is going to affect or is going to have impact on my obligations to my tax authority, that definitely would also prepare, I mean, inform my decisions or my actions when it comes to dealing with the bank. So I think education of the taxpayer is also very key. And ultimately, once we're able to cover also having tax administrations as well, we're able to build and enable people to have that confidence in us as an institution. All this will go in a long way in kind of closing the gap. But the key thing, I mean, if you're going to put credit reference bureaus in perspective, I would say the key thing for now is to have them have a stronger regulations backing them. If I use my country as an example, currently I can say for sure that GRE, like I said earlier, we're not doing much with the credit reference bureaus, but clearly from the presentation discussion we've done so far, it will be a very good place to look at. Then again, I mean, to help us meet our target. So let's have the necessary backing. Maybe later in the other discussion, the presenter on that subject on the credit bureau probably can speak to it. I mean, I don't know to what extent, what legal backings they have in administering their jobs. But if we have a strong reference bureau, I'm sure other institutions aside even revenue authorities can continually rely on them and, you know, mobilize as much revenue in our context or close the compliance gap. Thank you.
Thank you, Mr. Mensah. And that takes the question to Laban. From the earlier presentation by Richard Musime, we heard that the credit reference bureaus may be licensed by the central bank. Some credit rating agency will be licensed by the Capital Market Authority. And the question I want to ask Laban, first of all, does the Zambia Revenue Authority have some working arrangement with the Credit Reference Bureau, or is there any sort of linkages that they have with the local CRBs? And has that ties back to our question, how has this been used to reduce the cost, or how can this be used to reduce the cost of compliance management? Thank you, Laban. The floor is yours.
Thank you, Mr. Ondoro. And thank you again to my colleagues Geoffrey and Gilbert. I think Geoffrey already touched on one point I wanted to make, which is good, so I'll skip that one. To answer your question, no, we are not using data from the Credit Reference Agency here in Zambia to enhance taxpayer compliance. But seeing the presentation by Richard, I think that was something we should be doing as soon as possible. Which brings me to the things that we need to do to get to where we want to be. The starting point, Duncan, is to ensure that the tax laws are harmonized with financial services laws that are in place in these countries. What we found in our case is that financial data is heavily protected, even from revenue authority. The only way you can access financial data is if you have a court order or the request comes through the Financial Intelligence Center. So such a setup obviously limits what we can do with data coming from the Credit Reference Bureau. One way to go about this problem is to sign a memorandum of understanding directly with the CRB to ensure that we are able to access this data in some way. A lasting solution would come by way of harmonizing these laws. My colleague Geoffrey talked about making the exchange smoother, automated, so that you don't have to send the letter every time, which is good. I totally agree with that. Another issue that we need to deal with is to create a platform for heads of these agencies or the key technical persons in these agencies to meet regularly and frequently, and create trust around the use of this data. If you're going to sit in an office like this and pick up your phone and request for data from the CRB, it will not come easily. So there's need for all the agencies to meet regularly and share whatever problems they may have in the exchange of data. But I think the best approach is for all national governments to ensure that they have a biometric identity for their nationals. The cause of the many credit problems that we have, which extend to the tax compliance, is as a result of the unreliable identity data in these countries. So if the identities of taxpayers, especially the natural persons, can be known for certain, it will be easy to trace them through the entire government system, whether it's through the Credit Reference Bureau or the tax authority. So what we've done here in Zambia, for example, is that we are launching, we'll be launching a project to digitize all persons' IDs, and that will serve many purposes, including tax compliance. If you can be sure of your ID, we can trace you wherever you may be. Another dimension, Mr. Wanduru, I think, which is important, is to strengthen the data protection laws. This is new to many countries. With the advent of technology, more data is being collected on all kinds of systems, the tax system, the banking system, the school system, even the medical systems, the hospitals, and so on and so forth. But governments should put in place laws that safeguard the safety of that data sitting on those systems, because public distrust and mistrust on the use of data stems from the fear of this data finding its way in the public. So part of the reason is to overcome that by putting in place data protection, very strong data protection laws, which stipulates the penalties for any person, that goes against what the law says. This is very important, and these are some of the things we're doing in Zambia to lay the ground for a fully digitized environment. Finally, in the long run, I've noticed this in the developed world, countries have made a policy to relax the confidentiality laws surrounding financial data, including tax data. So you find in some countries, for example, in the Scandinavian countries, even closer to home in South Africa, tax data will be made available after a short period of about 5 years. Such a law will make financial data to be not a taboo topic, so that everyone can feel comfortable, looking at financial data of persons and companies alike, because greater transparency ultimately benefits taxpayer compliance. That would be my answer. Thank you so much, Mr. Ambi.
Thanks, Laban, for re-emphasizing the importance of data protection. I see a very interesting comment from our chat. This is from Damakrin Jadigisi. It's something she has posed to everybody, and I think we have talked about it. She says most human beings are scared of being shamed, especially being listed by the CRB. I see this as a behavior that tax administration can take advantage of towards enhancing voluntary compliance. Is it possible for tax administration to partner with the CRBs towards listing non-compliant taxpayers? This can be done after risk profiling is achieved, so that those in the red profiles are the only one listed. Maybe if you could have just a quick 1 second comment on Damakrin's view, starting very quickly with Geoffrey.
Thank you. I do agree with Damakrin's comments on the fact that most people do fear being listed by CRBs. Not, I mean, that is very valid, and I concur that revenue administrations need to work closely with CRBs, because this information goes both ways. They are looking for clients to credit rates, and those clients happen to be revenue authorities clients again. So it's a win-win game. As for blacklisting tax, those that are red profiled for tax purposes, I may say that would depend on jurisdictions. I think that is something to be very, very vigilant about, because at the end of the day, in my understanding, the arrangement of exchanging information would be between two institutions. and a taxpayer should be protected under the tax administration laws. So if you expose them and they are listed in another institution whose arrangement was not known to between the taxpayer and the tax administration, I think there are a lot of considerations to make. One, there may need to be other legal proceedings to begin with, so that that would come as a last resort, that someone has totally failed to come forward and clear dues or even reveal whatever constraints they may have with the tax administration, so that if it's the last resort, they are blacklisted, not to be transacted with. That's how I can go about. I don't think it can be that straightforward. It may require a lot of work, more than just risk profiling. I submit.
Thank you. Gilbert, any intervention on this very quickly?
Yeah, on this one quickly, I also agree. I agree with what Damakrin said about, is it possible for tax administration to partner with SER? Yes, it is possible, but to ensure, of course, like I said, voluntary compliance is the best place to be. However, certain initiatives or actions have to be taken by tax administrations to sort of, should I say, either put fear in taxpayers, for want of a better word, or to coerce them to also comply. And among others, that would also mean to either publish the names of people, put the names out there of taxpayers, be it institutions or persons who are, after deliberate efforts to engage them, but they're still not complying. I think it would be fair to put that information out there for the public. And again, this will serve as a deterrent for other people. So, which invariably means what? If it serves as a deterrent, that means what? Compliance is going to improve. So I think it's worth considering. It's a way to go.
Thank you. Laban, any final thought on this? Observation?
Yes. In theory, name and shame should work, and I'm using the word should work. But in practice, you find that there are many problems with that approach. We tried it once here, when we tried to name and shame taxpayers who are failing to issue a tax invoice, when we noticed that VAT compliance was quite low. But that program didn't go quite well, so we had to retract it. Usually, what you end up doing is that you have a pool of frustrated taxpayers, or you injure the goodwill of the taxpayer to come back to you and comply. So perhaps it shouldn't be the first option on the list of on the options for the taxpayer, because of the many consequences it has. In some cases, name and shame amounts to declaring someone bankrupt. It spoils their ability to carry on with the business, whatever they are doing. So I would say it would work, but it shouldn't be the first option. Thank you so much.
Yes, I hear you, Laban. I think that takes us back to the first question between risk appetite and risk tolerance. We see how to balance it. Now, I think we are coming to the end of our time slotted for us. I can see there's a hand up from Justin. Justin, the floor is yours.
Thank you, Duncan. I just want to volunteer Frank Scott, who is from the IMF. He has some experience in this area, and it would be good for him to tell us something very briefly. These are not my closing remarks, of course. Thank you.
Let him proceed. Take the
Frank?
Yes. Sorry, I had to make some settings in place. Well, thanks for inviting me, Justin, also to share some of the experience. With apologies, I couldn't follow the entire presentation so far. I was deleted, kicked out of the meeting several times. But I thought it would be good to share some experience we had when I was working at the Dutch tax administration, where we designed a so-called early warning system, and it was based also on the relation with financial institutes and credit rating agencies to see how can a tax administration find a solution to identify taxpayers who are going into default on a short term. And therefore, we invited some financial institutes from the Netherlands and shared experience with them. And to our surprise, it came that what we thought that credit rating institutes and financial institutes would use in daily practice was not that well designed as we expected. And that brought us to a stage where we could learn a lot from each other. In this phase, that mainly the trend analysis we could use from VAT returns in combination with withholding taxes would also be very beneficial for the tax administration to identify those taxpayers who can come and default on shorter term. And I think from also from the IMF side that the information the tax administration has on real-time transactions from taxpayers can be very beneficial. So I think the invitation goes to all tax administrations to see in what way you can combine lessons learned from today with data already available from mainly VAT returns and other tax return information, which is very accurate and very up to date. That's all I want to add. Thank you very much.
Thank you so much for sharing that insight, however brief. And thank you, Justin, for just volunteering last minute to bring in that level of experience. It will be quite encouraging for a number of tax administration represented here to share further with him on his experience. I know we still have a wide frontier to go on that particular aspect of the POA in risk management, and that cuts your work, Justin, and the Secretariat out for you. I know you are doing a marvelous job. I've just seen you have volunteered to organize a peer-to-peer platform for in collaboration with ATAF, and even us as Commonwealth will be very happy to join in that initiative. Noting our time running close to an end, I would now close this session officially and invite Justin to give us some final thoughts before we log off for the day. Thank you so much and welcome, Justin.
Thank you, but I think Samira, you're the one supposed to to come in, and then I'll come in late. Thank you.
Yeah, I just wanted to also give an opportunity to Mr. Richard to respond to one question that was posed through the YouTube. There's a question to Richard. Is there a way tax compliance scores can be made a part of the compliance ratings bureau rating? So can you maybe respond to that question in just 1 minute before I hand over to Mr. Zake?
Okay, thanks, Samira and Alan for that interesting question. Yeah, it's true that in the calculation of our bureau score, we consider a number of parameters based on the information we have at the bureau. So once tax administrators start submitting tax compliance data to the bureaus, then we can use that data to calculate the bureau score for each and every tax client. And therefore, it's possible to incorporate tax scores into the overall bureau score. But that means that the tax administrators will not only submit clients in their red list, but also in the green list. So taxpayers who are doing well should also be submitted to the Bureau. Those who are doing poorly should also be submitted to the Bureau, so that both sides benefit from the Bureau scope. But it's very possible. Thanks, Alan, for that question.
Thank you, Richard, for that. I just had a minor technical glitch with my computer screen, just went off, but I'm back. Thank you, Mr. Nduru, and the panelists for sharing your experience and expertise with us during this very informative and robust discussion. And as you can see from that information that was shared, that indeed the information from the Credit Ratings Bureau can assist in risk management and ultimately increase compliance, but some challenges do exist, and harmonizing laws as well as regular engagements with agencies are crucial to increase the sharing of information. So with that, we have come to the end of this exciting information sharing and learning event, and I am positive, like me, you have also benefited in some way from the discussions and presentations that have been shared with you today. I would like to now invite the head of the TADAT Secretariat, Mr. Justin Zake, to do the closing remarks. Mr. Zake, you are welcome.
Thank you very much. Thank you all for attending this session. It's really been great. It's insights, and for some of us who've been in tax administration for a long, long time, takes us back to all the reform efforts that we've been trying to promote. Some have been implemented, but challenges remain, as Samira has said. But I think what is important, at least for me, I've been repeating this in other forums as well, let's not reinvent the wheel. Let's share experiences. Let us also work together. And I like the idea of, from Zambia, of functional heads in these particular specialist areas to meet more often. So I volunteered ATAF. Mary, I'll invite you for a very short skit on that one. I've invited ATAF to start setting up these forums for the specialized areas, and the TADAT Secretariat is willing to partner as it has done today. The other issue I can raise is there's a lot of food for thought. The legal issues that need to be, fathomed, but there are countries that have done this. I can quote Ireland. The Irish Revenue Commissioners have partnered with financial institutions in order to overcome some of these issues that have been raised as, possible impediments. Frank from the Netherlands, I volunteered him because we've had a discussion on these issues before. So don't fear the unknown at all, even if it means that it's piloted and we learn from these pilots that we are doing. I mean, for example, even when TADAT started, we started piloting, with 3 countries initially, and then now we have done 120 assessments globally. The 121st should be finished next week, and then there are another 8 that are coming up, actually 13 between now and the end of April. So let's not fear the unknown. The direction rather than the speed is important, but once you set the direction, you can set the moderate speed. What is also important is partnerships. I mean, if you don't partner, you can't really make progress, and that has been mentioned. But there's real food for thought out of these sessions, and at least from the TADAT Secretariat side, I pledge that we will be able to continue this whole process. It's very exciting to bring people together. In effect, we are creating communities of practice, and we'll be working together with various agencies in order to widen this whole process. As we speak, this session is being broadcast globally through the TADAT channels, and I want to appreciate everybody who has had a hand in organizing this. Samira for anchoring. There are people in the background there in the kitchen who have made this possible. Annette, Blenda, Wofai. We have a technical crew led by Roland Millman. We also have our interpreters. Thank you so much for what you've been able to do. Now, before I declare this session closed, Mary, I volunteered ATAF. You better say something and then I'll close. Mary?
Thank you so much, Justin, and thanks for volunteering, ATAF. But like I indicated in the chat, we'll be more than happy to take a shot at this. And I know, and listening even to the panelists and the obvious advantages, I think it's something that we are very, very keen to look into. And we will be putting our heads together, and of course, we'll involve you and everybody else who can add value to this, so that we continue this discussion. We certainly and definitely will take this to the next level. Thank you.
Thank you, Mary. There's a lot to say, but you know, when we start talking about that and all these opportunities that are available, we don't stop. If there are any questions that are unanswered, we have that Soundbites channel that we invite experts to come and respond to these questions. So if there are any questions, please send them to the TEDAT Secretariat, and then we'll be able to advise you, all of you, when these are being responded to on the TEDAT Soundbites YouTube channel and also our LinkedIn channel. With those very, very many words, I'd like to close this session, and thank you very much, everybody, and please stay safe and healthy. Thank you.
Thank you.